So obviously we've been in depression in 2007, but the new Great Depression is where we are now. And inflation has been running hot since last spring, since April, May of 2021. And some of the monthly numbers have come in, whether it's the producer price index, PPI or CPI. They're printing numbers that are the highest in 30 years. I would look for disinflation. I'm not calling for deflation. Deflation is when prices go down. I can't rule that out, but I don't see that. That's not my intermediate term forecast. But disinflation is. I see these numbers going down from 6%, 7% annualized, which is what the government's showing. Getting down to the 4% level and eventually down to the 2% level, which is where it was from 2009 to 2019 during that 10-year expansion. The Obama and Trump economies were kind of the same, right around 2.2% growth. Inflation was between 1.6 and 2. Rarely, if ever, touched the Fed's target rate of 2%. That's where it's heading again. So not deflation, but disinflation. This inflation bubble is going to go away. Disinflation is inflation at a lower rate. So now you still have inflation, but if it goes from 8% to 6% to 4% to 2%, which is what I'm saying, you still have inflation, perhaps inflation of 2%. And that's not trivial. Look at the value of the dollar and a half in 35 years. So it's, by the time you're, most people are young adults at the time their kids are in college, it's about 35 years, so, or less. So that's real. But going from 8% to 2% is a big deal for a couple of reasons. Number one, it means that 8% number is not sustained. If it is, if I'm wrong, I don't think I'm wrong, I wouldn't be giving this analysis. But if I'm wrong and inflation goes 8%, then it's probably on its way to 15. So that's a completely different scenario. That's not the scenario I see. I do the analysis. I have a view. I look hard at the data. I have models. So I exercise a lot of care on this, but I don't just ignore the alternatives. Sometimes you're wrong and you have to pivot. So yeah, we should all be watching for signs of inflation. I don't see them. I see disinflation, which means you still have inflation, but it's at a much lower rate. But there's a world of difference between, let's say, 1.8% inflation and 6.8% inflation. Those are completely different worlds because one is much more manageable, but it also changes expectations. And expectations are the key. The Fed doesn't control inflation. Everyone's like, oh, they print money, you get inflation. That is not true. It's not true in prices. It might be true in asset prices. It might be true in stocks and bonds and real estate, but that's not the consumer price index. That's not what the Fed looks at. That's not what most economists or many economists mean when they say inflation. They're asset bubbles. Money printing can lead to asset bubbles, but it does not lead to price inflation unless velocity picks up. Velocity is a psychological phenomenon. So if you change the expectations and change the they change the psychology, and change the velocity, you will get inflation, but I don't see any of those things changing. What I see is this runs out of steam and we get back down to below 2%. In 2021, we don't have the fourth quarter numbers yet. It looks like the fourth quarter will be decent, maybe relatively strong. The third quarter was quite weak. The fourth quarter of 2020 was quite weak. We did have another strong quarter along the way in 2021. So it's kind of jumpy. We're getting some strong quarters followed by weak quarters. But now I would expect that to trend lower. I think we're going to see that very quickly. And in addition to the pandemic, which we just talked about, there's a new headwind to growth, a big one, which is the supply chain breakdown. And that's an area I'm devoting a lot of time and research to right now. So between the new Omicron variant, which fortunately is mild, appears mild, it's highly contagious and relatively mild. So it's kind of like the cold or mild flu version of COVID. But it's around and it's affecting, people can't believe how quickly it's torn through New York City. And nationally look for 1 million new cases a day. Now, fortunately, they're mild, but it's still enough to keep people home from work. It's still enough to some people unfortunately are in the hospital. But even if you're home for 10 days, you're not working for those 10 days. So this is a new headwind on top. And then we have the supply chain crisis. So I would say we've been in depression in 2007, but the new Great Depression is where we are now. It's, by the way, that book has 3 chapters on economics, the new Great Depression, but also has 3 chapters on the pandemic. So it's kind of it's a mixture of the impact of the pandemic and then the effect it had on the economy.
Fantastic book.
You can't disentangle the two. I had a debate with my editors. Jim, we love you on economics, but you're not an epidemiologist. I said, well, I know I'm not. I'll admit to that. But you can't, writing about the economy and not mentioning the pandemics, like talking about property damage in New Orleans in 2005 and not mentioning Hurricane Katrina. I mean, you have to mention the pandemic, and I did. And I included a chapter on the mental health aspects, by the way. There's a lot in that book that was way ahead of today's conventional wisdom. I said I concluded that the virus came from a laboratory in Wuhan, that today that's the consensus. I said that lockdowns don't work. Today, that's the consensus. Masks don't work. Today, that's the consensus. But all this stuff was heretical, a year ago when the book came out, but it's all in there. But as it relates to the economy, it's just one more reason. Now, having said all that, yeah, COVID has not gone away. The pandemic's still here. It's still depressing growth. And inflation has been running hot since last spring, since April, May of 2021. And some of the monthly numbers have come in, whether it's the producer price index, PPI or CPI. They're printing numbers that are the highest in 30 years or sometimes longer. So we're going back to, if not the worst of the 70s, at least the early 1980s, but in some cases longer for these inflation numbers. So inflation is showing up. So that's undeniable. You can argue about the forecast, but it's here. The worst collapse since 1946. And one of the worst in American history. So we didn't just have low inflation in 2020. We had deflation. Prices were going down. So when you get to 2021, the year-over-year comparison, of course it was going to go up. Of course that was going to be more than usual. That was completely expected. It's hard to disentangle what I just described as the base effect from it's called real inflation, real price increases. But the best estimates were about half of it was a base effect. So if you were seeing a number of 6% inflation, that was about what it was. You could say, well, it's kind of 3 real and 3 base effects because we're comparing to a very weak year. However, as you got into August, September, October, the base effects started to go away, which is, you say, well, what was going on in August, September, October 2020? Well, that was one of the strongest periods of growth in U.S. history. That was the other side. It went down and then it came back up. It didn't make it all the way back up. But yeah, that was a strong rebound in the third quarter of 2020. So you would expect, so therefore the base effects went away. But the inflation remained hot. It didn't fade as much as I thought it would. It was like, okay, well, the base effects are gone, but the inflation is still there. In fact, by some measures, it's even worse.